Why was Glass-Steagall repealed in financial history? Have you ever wondered why a law designed to protect our financial system was overturned? The Glass-Steagall Act, passed in 1933, aimed to keep commercial banking separate from investment banking. This separation was a response to the banking crises of the 1920s and early 1930s. It was believed that by limiting the activities of banks, the risks in the financial system could be reduced. However, over the years, the financial landscape changed significantly. By the 1980s and 1990s, federal agencies and courts began allowing more overlap between commercial and investment banking. This shift reflected the evolving demands of the market and the rise of financial innovations. The formal repeal of key provisions of the Glass-Steagall Act occurred in 1999 with the Gramm-Leach-Bliley Act. This new law removed the barriers that prevented banks, securities firms, and insurance companies from merging under one holding company. The goal was to modernize the financial system, enabling institutions to offer a wider range of services. This change was seen as a way to improve competitiveness both domestically and internationally. The repeal was influenced by several factors. First, the gradual weakening of the Glass-Steagall Act through regulatory interpretations and court rulings made it easier for banks to expand their activities. Financial institutions were eager to broaden their business lines, and the political climate at the time favored deregulation. Additionally, low interest rates during the 1990s pushed banks to seek higher returns through new activities, including securities and insurance. After the repeal, there was much debate about its impact on the financial crisis of 2007 and 2008. Some people argued that the combination of commercial and investment banking led to riskier behaviors that contributed to the crisis. Others believed that the crisis would have happened regardless, pointing to other factors like mortgage lending practices and credit bubbles. Attempts to reinstate parts of the Glass-Steagall Act after the crisis were unsuccessful. However, the discussions highlighted ongoing concerns about how financial institutions are structured and regulated. The repeal of the Glass-Steagall Act marks a significant moment in financial history, showing how regulatory frameworks adapt to changing economic conditions and market developments. In essence, the repeal was a response to the evolving financial industry, allowing banks to diversify their services and compete more effectively. Yet, this change remains a topic of discussion, especially in light of the financial instability that followed.